Hello and welcome to everyone who is joining us on today's webinar, Holistic Approach to International Residency and Citizenship Planning for South Africans and the Impact on South African Tax Residency and Exchange Control. The theme of today's webinar is rather complex, and although we cannot truly dilute it, our aim, the three of us together, is to provide you all with as much information as possible in a simple and practical manner. So before we get started, just some house rules that I've been asked to share with everyone who's joining us. Please note that this webinar is being recorded. The link will be shared with everyone who has registered and with some additional information like the slides and our contact details, the presenters, in the upcoming days. The webinar should run for about an hour with an opportunity for questions from anyone in the audience thereafter. So please feel welcome to use our comment section, which should be on your right-hand side of your screen, to ask us any questions throughout the presentation. We'd be happy to address them after we've all gone through the content. All right, so I'll start by introducing everyone that will be presenting today, the three of us. My name is Danny van Vuren. I'm a consultant for Sovereign Group based in South Africa, in the beautiful mother city, Cape Town. I'm joined by my colleague, Kerry Prattley, who heads up the Residency and Citizenship Service Department of Sovereign Group, and he's calling us from Phuket. And last but absolutely not least, we have Peter Miller, a consultant for Fin Global, who is joining us today from Hermanus. So today's agenda, it is jam-packed, and we've spent a lot of time thinking how to simplify this in a way that we don't miss the key information, and it's always quite tricky because it isn't just black and white when it comes to this theme. But we'll be covering a brief introduction to Sovereign and Fin Global, who we are, where we are, and what we do. I'll briefly go into the differences of citizenship, residency, and tax residency. They aren't the same, and you'll come to understand the details around that later on. We'll also then unpack the residency program categories. This is quite important because I think in the South African context, a lot of us have been exposed to residency by investment only, purchase property offshore and acquire residency through that route, and that's absolutely not the case, and Kerry will go into details around that. I'll briefly touch on the importance of residency and citizenship planning, having a strategy as a South African if you or family members are thinking of acquiring an alternative residency, tax residency, or citizenship, what kind of topics would we be looking at before we execute, and what that planning looks like. And then Kerry and Peter will go into detail covering a few practical scenarios. And this is going to be from a sovereign and from a Fin Global perspective. And then we'll move on to frequently asked questions and misconceptions that are quite common when we consult with South Africans in South Africa or abroad, and we'll try and cover some questions from the attendees at the end. Hopefully we don't run over time, but if we do, the three of us will hang around to address some questions thereafter. A quick introduction to who Sovereign is. I'm part of the Sovereign Group, and Sovereign is a multi-jurisdictional consultancy firm, and it is one of the largest privately owned trust and corporate services providers. Established in 1987, we specialize in foreign residency, offshore structuring, and cross-border planning for individuals and families as well as companies. We have offices in over 20 jurisdictions worldwide, mainly throughout Africa, Asia, Europe, and the Middle East.
Thanks, Danny. Just a brief intro regarding Fin Global. As Danny mentioned, we're based in Hermanus, which is really, really amazing. We were established in 2009 as cashcows.com. We set up an Australian office from an operational perspective in 2012 that was based in Brisbane. In 2014 was really the start of our relationship with Bidvest. We onboarded them as a strategic foreign exchange partner. And then in 2015, we launched something that we're really proud of, and we're the only service provider in South Africa that includes this in our value proposition, and that is a tax refund service specifically related to the dual tax agreement between South Africa and 29 of the 79 countries that we have an agreement with. So we're very proud of that initiative. Then over a period of time, starting in 2017, Bidvest Financial Services started acquiring shareholding in our business, and that coincided with a rebranding from cashcows.com to FinGlobal. In 2017, Salesforce, everyone knows them, pretty massive, and we use their platform for our CRM activities and management. And then in 2021, the acquisition of FinGlobal was completed by Bidvest Financial Services, and as we sit here, we are a wholly owned subsidiary of Bidvest Financial Services. We do tick all the boxes from a regulatory and a compliance perspective, as you can see there. Authorized treasury outsourcing company with SARB, licensed financial service provider, registered tax practitioners, and 70 full-time employees with a few contractors. And we're proud to say that we are the largest white-collar employer in Hermanus.
Fantastic. Thank you. Thank you, Peter. So before we get into the finer details that Kerry and Prattley will go into, Kerry and Peter will go into, it's really important for us to understand the differences between your citizenship, residency, and tax residency. I think in the market, there's a misconception that if I acquire a second residency, it will allow me to get a passport in that jurisdiction. If I acquire a second residency, then I will become tax resident in that jurisdiction automatically. And the same applies with citizenship. So obviously there's different programs with regards to residency, citizenship, and tax residency, but it's really important to understand the key differences. So residency allows foreign nationals to reside and or work in a specific country, and this is usually in accordance with specific conditions and provisions of each jurisdiction and program. So residency can be temporary in nature, it can also be permanent, and then the same moves into citizenship, but citizenship is more finite. So it allows then for individuals to have specific rights, privileges, protection within that country, and it is deemed to be more permanent. In South Africa, we see it as a passport, right? And then in terms of tax residency, of course, from a jurisdictional point of view, it can differ the rules thereof. Each jurisdiction sets the rules, so each government will set the rules for establishing a tax residency in that jurisdiction and those tax incentives that are linked to it, but it usually speaks to your tax obligations as an individual. So just because you have acquired an alternative citizenship or residency does not necessarily mean your tax obligations in South Africa as a South African passport holder or tax resident has changed. It's really important to understand that you could have multiple residencies, citizenships, and tax residencies at the same period of time or for a specific year. And each program will have different rules. It changes frequently, and I'm sure Kerry will touch on that as well. As we've recently seen, one of the biggest changes was Portugal, and that was a shock to the system to a lot of South Africans, and I think a lot of people worldwide. So it's really important to stay close and understand what those changes are and who to deal with when inquiring and looking at an alternative residency. Over to you, Kerry.
Okay, thanks, Danny. Are we moving on to the next slide? Sorry.
Perfect.
Yeah, brilliant. Thanks. Okay, we'll start with residency, and government-approved residency programs are available to those who make capital investments, establish a local business, or are self-sufficient and inject capital into the local economy. In return for that, applicants receive a wide range of benefits, including the right to reside, settle, stay indefinitely in their chosen country. Obviously, they can also include their qualifying dependents. That might be their children, a spouse or partner, and or their parents, and in some cases even grandparents. provides access to high quality education and medical facilities in some countries. And in some instances, visa-free travel within cooperating territory. So, you know, in the EU, for example, it would be the Schengen area. In the Middle East, it's the GCC. And in the Caribbean, it's the common areas called the CARICOM. Also, you know, residency in addition, I mean, there are many benefits, but we're trying to narrow this down for the sake of this meeting. You know, eventual eligibility to apply for permanent residency or potentially citizenship by naturalization in the future. I'm going to come into the types of residency programs available in the next slide, but first I'd just like to cover citizenship and tax residency. So citizenship programs also provide the same benefits as the residency programs. But in addition to that, applicants also receive obviously a second passport and citizenship, the right to travel and also potentially live in cooperating countries, which is not the same as residency. That's only travel only. And again, you know, it's the travel and live in, you know, potentially in the EU, the Middle East GCC region or the Caribbean CARICOM. They also provide, which is slightly different, the potential to pass on your nationality and citizenship to future generations. So it's a long-term play there. Now, most countries, not all, but most allow dual citizenship, meaning that applicants, as Danny mentioned, you know, they are able to retain their existing citizenship. So there's not necessarily a need, unless it's to your benefit, to renounce your existing citizenship. There's a couple of ways to obtain citizenship, and that's through the standard investment programs that I think we're all aware of. You know, in the Caribbean, you can invest in property, government bonds, and or donations to the government. And the citizenship program can be applied for and completed within 4 to 8 months. In the EU, the only citizenship program that still exists is Malta. And there, the fastest option takes approximately 18 months to complete. But these sort of programs offer, you know, direct route to citizenship. Another longer term strategy is citizenship through naturalization, which requires applicants to usually emigrate, pay local taxes, and demonstrate strong ties and connections to the particular country, their chosen country. Usually they also need to pass a local language test. And, you know, citizenship through naturalization can, you know, it's based upon a predetermined number of years of residency within a country. So if you have legal residency in Portugal, Malta, or the US, you can apply for citizenship after 5 years. Bear in mind, these are not automatic rights. You have to apply for and meet the requirements under naturalization. In the UK and Guernsey, it's 6 years. In Cyprus and Greece, it's 7 years. And for example, Italy and Spain are 10 years. But having said that, if you're South American or from one of the former Spanish colonies, then that can be reduced to 2 years. So there's a lot of options there we can discuss with clients. From a tax residency basis, the programs provide individuals a special tax status, which, you know, depending upon the selected program and country, they may include zero income on tax or low flat tax on foreign sourced income, reduced taxes applicable to locally generated income, preferential local, corporation taxes, no estate duties and inheritance taxes. And also, one thing we need to take into consideration as well is, you know, double taxation agreements. So many countries have double taxation agreements, and obviously that comes into our planning as well. So from a tax basis, there are 2 qualifying categories. I tend to think of it as those that apply minimum stay requirements. So those that usually it's 183 days a year. So you need to spend at least 183 days a year in the country in order to be deemed a tax resident. But in some cases, such as Cyprus, that can be reduced to 60. On the other side, we can look at the minimum contribution to the local authority. So in Gibraltar and Malta, for example, they don't have minimum stay requirements. They do require that you do not spend more than 183 days in any other single country, not multiple countries, but single country. You're agreeing to pay a flat tax to the government on an annual basis. So there's minimum stay and, you know, minimum contribution. On an additional note, all tax residency programs require you have a local place of residence, and that could maybe rented or purchased. Danny, would you mind changing the slide, please? Sorry, 1 second. As Danny's mentioned, I mean, I personally speak to many clients who are actually unaware of all the options available to them when it comes to residency programs. You know, they might have looked online, or they may have spoken to a sales-based agent or something like that, and believe that the only option is to invest a large sum of money. But, you know, that simply isn't the case. I personally divide residency programs into 4 subcategories. Yes, residency by investment or golden visas is one, and it provides residency in exchange for a wide range of investment options, also donation options. Now these have low minimum stay requirements each year, so they're ideal for those who are seeking an alternative or second option. They're not planning on moving today. It might be something that they or their descendants or dependents take advantage of in the future. And these programs tend nowadays have a minimum of around 250,000 euros. Having said that, you know, I don't know if you're aware, but there's been a lot of changes over the last 24 months within this sector, and prices are going up. But currently, the minimum investment requirement is 250,000. The next residency category that many of our clients take advantage of is our financially independent or self-sufficiency visas. These provide residency rights to any applicant who can demonstrate an income and or personal wealth above a specified amount. So these generally, you know, require that you make the chosen country your primary place of residence and tax residence, but they come with a lower, you know, with lower requirements. So the annual income requirement age can range anywhere from 10,000 to 45,000 euros per annum, obviously making it far more accessible to a greater number of people. An alternative option is business startup investment and incubation programs. You know, this is another program that a lot of our clients come to us on. And they provide residency to applicants who establish a new business or invest in an existing business, and, you know, with the intention of creating local economic activity and employment opportunities within the country. So, you know, again, this is a relatively low minimum requirement of investment of 25,000 euros, you know, when we compare it to residency investment. Tax programs, I've mentioned this previously, but and they provide preferential rate for non-domiciled individuals. But the reason I've included in here is that some of them provide, such as Malta and Gibraltar, provide residency and tax residency rights under one program. The others don't, however. So if need be, then we can, you know, establish tax residency in conjunction with one of the other residency programs or even the citizenship programs that we've already discussed. As Danny mentioned as well, it's important to plan. So, you know, as you can see, acquiring an alternative residency or citizenship provides families a broad spectrum of lifestyle, business, investment and tax benefits. But, you know, no two clients' requirements and objectives are the same, meaning that planning must be approached holistically, not from the mindset that one or two solutions fit all. As I say, it is therefore important to plan, and please bear in mind that creating and implementing the correct strategy can take, you know, between 12 to 18 months or even more. It depends, you know, on the situation. I think that's it for that, Danny. Are we on to the next slide now?
Yes, absolutely.
Yeah.
Well, thank you, Kerry. I think the biggest thing that we see in South Africa is that we must understand everything doesn't run at the pace that we'd like it to. So when we do plan, although the timeline already is quite a lengthy timeline. We have to consider simple things like how long it takes to get a police clearance certificate. So these are simple, small things that we have to look at, and it's imperative that as South Africans we understand the programs, the rules, and the requirements. Is there a language requirement? What are we going to do to plan for that? That's a simple thing that I think is missed quite often, and how to plan. And of course, as Kerry mentioned, spot on, no client, no individual, no family have the same scenario. So the needs of each individual and their family would differ, especially when you're looking at considerations with regards to taxation in South Africa, in that jurisdiction, wealth and succession planning, business continuity. What does that mean if I do have a business in South Africa and I want to live in Portugal or Spain, for example? And then personal dynamics and objectives that each family has. Of course, if children are going abroad, we've got a lot of South Africans whose children are studying abroad. What does that mean when I'm planning? So there's some main points on the screen. Of course, there's so many different things that we cover when we do consult. But the first thing is to understand that the residency may impact your tax residency. And as South Africans, we were taxed on a residence-based tax system, and SARS taxes us on our worldwide income, worldwide capital. So what does that mean if I go to Mauritius and I purchase a villa, I want to acquire residency through that, I have no structure in place, and I've got this gorgeous property on the island? What does that mean from a South African point of view? Getting money in and out to make those purchases. Peter will touch on that. And seizing tax residency in South Africa is not automatic. I think especially in the younger space, clients are of the opinion that I go to Dubai and I work there for 2 years. I have no SARS obligation. I have no issues when dealing with the Reserve Bank. And that, of course, is not the case. What is our responsibility? What is the onus with regards to our tax obligations and dealing with the Reserve Bank as South African passport holders and tax residents? And then, of course, residency may also impact the flow of funds. And that can be anything in terms of how your business moves money, how you move money, how children perhaps need to receive funds and how that works. And then, of course, trusts and other vehicles that need to be considered, pensions, retirement planning, all of it is affected. And Peter will touch on that as well. And I'm sure he doesn't have enough time to cover it all, but he definitely will give us good insight. And then, of course, there may be, in most cases, a need for multi-jurisdictional wealth and succession planning. So in South Africa, we are privileged enough to have the freedom of testation. We can all draft a will, and if it's legally valid, it can be executed by our executors. But what does that mean for someone who is tax resident in South Africa that has other assets worldwide or structures? And I'll touch on that in the next point, which is the importance of having the right structure for your local assets in South Africa as well as those abroad. Again, there are various sections of your estate and your assets that can be dealt with in South Africa, but in terms of your international assets, how is that dealt with? How are your investments dealt with? How are your businesses dealt with? Your trusts, foundation vehicles that you might have in place? And again, in South Africa, a lot of our clients have local trusts. So what is the position of my daughter living in the UK who wants to benefit from my South African trust as a beneficiary? Or I have a offshore trust and I'm moving to Portugal and I want to benefit from that. What are those tax implications and the planning and the reporting around that? It's very important to note that there's no way that the structure that you have in SA will suit your international assets. It really has to be detailed, and you need to consult. And in most cases, clients have the opportunity to plan before they go and become tax resident in that jurisdiction. And that speaks to Kerry's point in terms of planning. If you know the timeline to that tax residency is 6 months onwards or 18, 24 months, it gives you an idea to say, how do we preserve and protect our base in South Africa? And the same with any assets that we acquire or interest that we have internationally. And then, of course, the right structure can qualify you for residency. And Kerry will touch on that as well. That will also bring about favorable tax benefits. Again, not just speaking to the international arm, we're looking at a South African point of view and the international point of view, that if I do have tax residency in a different jurisdiction, what does that mean for my South African tax obligations? It doesn't necessarily just go away just because I am living in Portugal for 6 months of the year. Kerry, over to you.
Thanks. So we're just gonna run through four, I think, case studies, really, just to sort of provide. We can't go into all of the different programs in detail because we'd literally be here all day, or longer. So just to be able to provide an overview of the types of options available and the types of scenarios we deal with on a day-to-day basis. So the first one here, we've got Andrew, who wishes to establish residency for himself and his children, possibly their parents and his spouse, but they don't intend to move immediately. But they do, want to have an alternative option or a plan B in place, should Andrew himself or his family members wish to take advantage, of the benefits available, at any time in the future. They also have a minimum investment of 250,000 euros to invest. So, I think the slide is quite self-explanatory. We do offer a number of programs here. We are talking about residency by investment programs here. So, as I mentioned previously, investing a set amount of money into a property and investment fund. In some cases, even companies can come under this sector, or giving donations to governments to use, as they wish. So in Europe, we offer programs in Cyprus, Malta, Portugal, Spain, Greece, and Italy. Obviously in Mauritius, which is, very popular with South African nationals. The USA, which I'm not sure has been talked about by us previously. There were issues for a number of years, but that program is now back on track and running. And opening up now the Middle East, so the UAE, Qatar, also Thailand and the Caribbean. All of these countries offer these types of programs. There are others as well. And if there's anything you'd like to talk about, you can ask us, because, if we don't do it now, then we do know somebody who will. Sorry, Peter, on to you, I think, really, to discuss the tax side related to residency programs, residency by investment, sorry.
Yeah, 100%. Thanks, Kerry. So for us, the most important part of this initial assessment would be that the initial intention is not to permanently leave South Africa. Okay, so that would mean Andrew and the immediate family, depending on age, if the kids are minors, etc., would still then obviously be classified as South African tax residents. And that, because we're taxed from a residency-based system, that would mean any worldwide income or worldwide assets that's being acquired over a period of time would then actually be, you have an obligation to declare that, etc. So that would fall within the SARS net. But classifying them as ordinary resident, because there's no intention to move initially, the initial focus from a Fin Global perspective would be providing assistance to get that initial 250,000 euro investment cross-border. Now, any South African resident who still has their South African identity documents, etc., do have the use of the single discretionary allowance, which is 1 million rand per person per calendar year. So we would obviously facilitate those transactions, depending on how the individual, if Andrew doing it all in his own name, we'd obviously do a 1 million transaction and then an additional 4 million to get that 250,000 euros out. As you guys know, there's no donations tax between spouses in South Africa. So depending on the urgency of the matter, we can then donate some of Andrew's funds to the spouse and use her SDA allowance with Andrew's funds. Just as a matter of fact, kids as well, under 18 minors would have the use of a travel allowance every year. That's 200,000 rand per child. So our immediate focus would be helping this family navigate the Reserve Bank requirements, getting the necessary SARS approvals to get the initial investment on the other side. There's no actual intention initially to change tax status. Okay, there could eventually, as and when the Plan B kicks into place, and this family decides, or individual parts of this family unit decides, that they would like to make Plan B their permanent abode, then we would obviously get involved from a planning perspective and getting the timing right there from a ceasing of SA tax residency perspective. Just as a point as well, very importantly, depending on the type of assets that this family unit or this individual acquires over time, some of the assets that you acquire in another jurisdiction could be capital of nature, and there's certainly ongoing consultation as we progress through this journey to fruition with Plan B kicking in. Regular consulting is important to ensure that asset accumulation in the other jurisdiction is considered carefully, because some asset types will have capital gains tax events and triggers when the move is eventually made and the application to cease residency with SARS is then submitted. Thanks, Danny. Kerry, back to you. Sorry, man.
Yeah, so the second case study, we're looking at Bongi wishes to move to a new country to experience and enjoy different lifestyle and culture. So she's actually making the move here, but she doesn't want to have to invest large sums of money up front. She prefers the flexibility and the ability to reside in country before making, having to make that sort of financial commitment, or even deciding whether she's going to stay there. She may wish to move somewhere else. So what she does have, however, is sufficient assets and, I suppose, or income to ensure that the important thing that countries look at is that the individual and family will not be financially dependent upon or a burden to the new country of residence. So in this case, we're looking at financially independency visas, or sometimes referred to as self-sufficiency visas. And, as I mentioned previously, these can begin anywhere from the requirement of annual income of anywhere from 10,000 to 45,000 euros a year. So it's a very good way for individuals to test the market, so to speak, or just to move to a country, because they do normally require that you move to the country and spend at least 6 months there, if you're going to renew, that is. So, again, you can see the many programs offer these types of visa in Cyprus, Malta, Portugal, Spain, Greece, also Italy and Mauritius, again, with the retirement visa. The UAE also has retirement visa, as does Bahrain and Thailand. Again, there are others. So, if you're looking at this sort of visa, please get in contact.
So from a Fin Global, yeah, thanks, Kerry. So from a Fin Global perspective here, Bongi is one of those cases, very privileged, asset based in South Africa. Income stream could be from multiple sources of income, and no initial let's assume she's got the ability to open an offshore bank account in the other jurisdiction. Again, making use of the 1 million rand discretionary allowance, making use of the initial 10 million rand foreign capital allowance, we could then externalize those funds. Just to clarify, on the amounts in a calendar year exceeding 1 million, that's the normal allowance, foreign investment allowance, is up to 10, but those amounts can actually be exceeded with Reserve Bank approval as well. Okay, so it's not capped at 11 million per calendar year. We've moved a lot more than that for individuals. The application to move more than 1 million in a calendar year is relatively simple. You just need to evidence the proof of source of funds. And once SARS has given the AIT TCS PIN approval, then both the discretionary and then the foreign capital allowance could then be moved to the offshore bank account or the offshore investment structure, whichever Bongi has chosen to set up. Then from a, let's call it a passive perspective here in South Africa, the move is made, the offshore account or the offshore investment has been funded. The really good thing about, and we'll cover this in some of the misconceptions, is Bongi's privileged. There's no obligation, just A, because she's leaving South Africa, and B, tax immigrating or ceasing SA tax residency. There's no obligation for her to dispose of these South African assets, and there's certainly no reason for her or motivation or need for her to stop earning the South African sourced income. Now, once she's abroad, obviously, then one needs to look at the motivation from a tax perspective and say, right, there's SA income here from whichever source, but let's assume she's cash flush. There's a money market account, or there's an interest component to the income that she generates from South Africa. One of the major advantages for someone in Bongi's scenario who's now settling in another jurisdiction, we want to get the SARS monkey off her back, and we seize her SA tax residency retrospectively. For a South African non-tax resident, the major advantage from an income, specifically interest income perspective, is if that is correctly submitted on the annual South African tax return, section 10(1)H, that specific box and section needs to be completed correctly, then even though it's declared the SA sourced interest income, it's actually fully exempt for non-residents. So that's massive. So Bongi can retain asset, can retain income stream, specifically then interest component would then be non-taxable and get full exemption from SARS. If Bongi's assets are, does involve a property portfolio as well, there's rental income, etc. Obviously, despite becoming a non-tax resident, the taxing right for SA sourced income of those other income streams would then obviously remain with SARS. Over time, Bongi could be doing quite well in the other jurisdiction, etc., and acquire assets, maybe start a bit, whatever the case may be, become economically active, earn an income, even though that was not the initial intention. And the other advantage, obviously, of becoming a non-tax resident from a SARS perspective is that you ensure that future income from a worldwide perspective and future asset acquisition from a worldwide perspective is ring-fenced completely out of a SARS net.
Okay, on to the third case study, where we've got Charles, who wishes to establish an affiliate business in a new jurisdiction that will provide access, obviously, to new markets and opportunities. As we said, doing so does provide access to educated and resourceful local employees. You can also work with local research and development partners, who are there to often provide government grants and so forth to implement, develop and implement business strategy and so forth. He'd also like to receive, take advantage, apart from access to the wider market, to receive regional, personal and business tax incentives, and also be available to travel, not have to remain in the country, but have the freedom to travel for business or pleasure as well. As you can see, we do offer, well, with Sovereign, one of our Sovereign's core services being corporate establishment, we do offer these services in a wide range of countries. So we've got Europe with, Cyprus, Malta, Portugal, Spain. The UK is still an option. Guernsey is another option, which is very closely affiliated to the UK, as one of the Channel Islands. Italy, Mauritius, UAE, the Middle East again, Saudi, even Bahrain, Oman and Qatar, and then Hong Kong, Singapore, the US again, Canada, although they have recently just capped the number of applicants they will receive, but we need to follow that, but it has been an option, a very good option until now. And again, the Caribbean. There's a lot of options here on this. So, with our expertise, internal and through our partners, we're able to assist on this level. It's one of the most popular program options we offer. So Peter, with regards to tax implementation there, yeah.
So in this particular scenario, Charles would still, being resident in South Africa, still have use of those 1 million and those normal resident allowances. He would also have the option, if it for a foreign direct transfer or foreign direct investment, and that would be if he chooses to make a direct payment from the SA entity to the entity from in the other jurisdiction. And about, obviously, that's more scrutiny from a corporate to corporate or entity to entity perspective. We are very fortunate, from an exchange control perspective. Our exchange control division, is just run by somebody who's written Reserve Bank exchange control legislation. So we're very fortunate. This would then potentially, if there's a South African entity that Charles involved in from a shareholder director perspective, and then the structure that you guys put in place, there could be exchange control or Reserve Bank approvals necessary for things like related party payments, entity to entity, shareholder to shareholder. There could also be the need for the regularization of loop structures potentially, as the flow of income and compensation flows between the two entities, etc. Thankfully, all of these exchange control applications are done internally, through FinGlobal. But the important thing here is that depending on the type of transactions, there could be Reserve Bank approval required. And it's obviously very important to get that right the first time of asking, to avoid business interruption, etc. Gary?
Yeah, and finally, with regards to the case studies, we have Paul and Michelle who, wish to establish a new country of tax residency. So they're no longer residents in South Africa. They're internationally mobile, meaning that, they're not necessarily staying in. They may be spending 3 months in one country, 6 months in another, and then a month in 3 others. We have a lot of clients like this nowadays. They've chosen one of the residency or citizen options that we've already discussed, and they wish to benefit, to establish the tax residency, because you can't really do anything financially now if you don't have an established place of tax residency. And so they'd like to be able to establish tax residency and benefit from, local tax rates and incentives that are provided by such. Now, not all of these have specific tax residency programs. They either offer non-domiciled tax residency programs with special tax rates for a set amount of time, whether that's 5, 10, or 17 years, or they are low tax jurisdictions. And as you can see again, we include Europe there, the UK, although there is some change on the non-dom rules there. However, it's not all bad news. I mean, it does look as though there'll be a 4-year window there for newcomers. Gibraltar, obviously, Guernsey again. Even Italy and Greece, they have flat tax rates and special tax rates for retirees that is of 7%. Mauritius is also a low tax jurisdiction. And then again, UAE, the Middle East, Qatar, Oman, Saudi Arabia, Bahrain, and the Caribbean are all low tax jurisdictions. So a lot to choose from.
Yeah. So in this example, Paul and Michelle have already ceased SA tax residency. So now their need is to really just draw the line in the sand and completely deregister with SARS. Now, in order to qualify for tax deregistration of your South African tax number, that's also a misconception which we'll possibly cover later. The tax number doesn't deregister when you cease SA tax residency. The status just changes to non-tax resident. So to qualify for actual deregistration, there's a couple of things that needs to be in place. You obviously need to have a fully compliant SARS tax e-filing profile, no outstanding returns, no penalties, no refunds even. so you need to get those ducks in a row, make sure that's happened. You need to make sure that you possess no remaining assets in South Africa, and that runs deep all the way down to even an active bank account. So no active assets operational in South Africa. Then you need to obviously have that non-resident confirmation letter that SARS would have issued with the initial tax immigration application. And then obviously you need to evidence to SARS that you hold a valid tax residency confirmation in the other jurisdiction. Then we can conclude the actual tax deregistration process. Now very importantly, once you've done that, it could be that Paul and Michelle have ceased their SA tax residency more than 3 years ago. So now there could have been restricted funds in South Africa, retirement annuities, restricted preservation funds because of previous withdrawals, etc. Now they've ceased residency, they've been tax residents in the other country, other jurisdiction for longer than 3 years. So that then makes those previously restricted funds, accessible. You can surrender those in full. Obviously, SARS will take their slice of the pie, but those proceeds can then be transferred to the new jurisdiction. And obviously, that makes a heap of sense for folks who's really pulling the trigger, drawing the line in the sand. That you just try and start making provision or top up your existing provision for retirement funding investment purposes in the other jurisdiction. Very importantly, they now we terminate the retirement annuity, we get the funds out as non-resident. This hasn't been touched on previously. I mentioned as residents, you've got the 1 million and the 10 million and exceeding 10 million with Reserve Bank approval. But how do you move your money then as a non-resident? You don't lose the ability to transfer your income or your capital. The same would have applied to Bongi in the previous example after she ceased residency. If you're moving income from a South African source after you've ceased residency, then purely a good standing TCS PIN, tax clearance for good standing, SARS and the acronyms, is required. If you sell a property, or in this example, you terminate your retirement annuity funds, obviously that's classified as capital. And then your equivalent of what we now know as the AIT TCS PIN would then be required to get approval to get the post-tax proceeds transferred to the other jurisdiction.
Peter, Kerry, thank you for your insights. Naturally, we can see that it's not as simple as just putting it in a box. There is a plethora of information that we have access to that Peter and Kerry and myself will be sure to include in the email that goes out to everyone. But for the last 10 minutes, let's go into frequently asked questions. I'll cover some that we've picked up in the Sovereign Group office in South Africa specifically, but of course, we've also got a lot of South Africans that are abroad dealing with our other offices. So the first one would be, can I maintain my South African citizenship and obtain a second or third residency and or citizenship? Yes, absolutely. So as Kerry alluded to earlier, residency generally leads to citizenship at some point in time. So having a second residency or third residency will not be an issue at all. But as South African citizens, once we want to apply for a second or third citizenship and we want that dual citizenship, then we would need to apply to retain that. So we must understand that process and how that works in the two jurisdictions. Do all residency programs include dependent children and or parents? Again, Kerry's covered that. So it depends on the objectives and we've seen, as with Mauritius, for example, they are very open in terms of the number of programs that are available. So if you do have a dependent child, minor child that you would like to include, you'd need to find the program that works for that. And same with parents, sometimes they can be included, again, depending on the jurisdiction and the rules of that program, but there's a lot of information we can share that can give you more idea of where that would be possible and where to explore. Are all residency programs permanent? So as I explained earlier, your residency programs can be temporary in nature, so they could be for a fixed period, or they could be permanent. Like a simple, very popular jurisdiction in South Africa is Mauritius, right? So it's close to home, 4 hours from Johannesburg, and very popular to the South African market. You can apply for a retirement permit when you're older than 50. It's set for an initial 10 years, but that can move into permanency after 3 years. So that's an example where it can move from a set period to a permanency period. And then, of course, in some programs, you can actually move into citizenship. And there's a whole bunch of rules around that. And Kerry's alluded to that as well. Can I set up an offshore company or trust to hold the property I purchase for residency? The question would always be, what is the jurisdiction? What is the value? And then, of course, where will you be a tax resident? And the planning will be around that. So can my South African trust own property offshore? That's an important question, and the answer to that is no. Can I set up an offshore trust that can hold that? Again, from Peter's point of view, how do I get the funds? How do I establish that trust? Can I allow for a loan? Do I make a donation? Both have very different tax complications. And then, of course, the jurisdiction. Does it allow for that structure? So if we go to the Middle East, can we use a trust, or should we use a foundation as a vehicle for holding that asset? If we go to Portugal, if we go to France, shall we be using a trust, a foundation, or a company? So really important to understand the implications of that asset, if it allows for in that jurisdiction, and where you are actually tax resident. And the last frequently asked question of a long list is, which residency programs give me access to visa-free travel throughout the Schengen area? Now, Kerry has touched on that. You'll see popular ones being Malta, Portugal. That changes. We know Cyprus have approached for many years with the hopes that they can also get into that circle. And we are watching that closely, of course, that can change over time.
So moving on to the stuff that we encounter, as Danny said, the list is a lot longer than this, very condensed. Must I pay tax on money I transfer from South Africa? So generally speaking, as soon as the South African hears the word SARS, they go into a panic. Now is tax clearance required for me to move my own money out of the country into whichever jurisdiction, if an amount exceeds $1 million, obviously in the calendar year. So just, you know, we put people's minds at ease and say, listen, the tax clearance is purely just a compliance regulatory thing, showing that your ducks in a row, you're compliant with SARS, and more importantly, it relates more to money laundering, validating the legitimacy of the funds, that it's your source of funds, that it's your investment, etc., or in the case of a spouse, etc. So it's more about money laundering and validity of fund scrutiny, and it is really about, you know, the funds being taxed when you apply for tax clearance and sending it out of a country. So exactly how do you cease your tax residency? That's a big misconception. SARS used to have a box that you could say, I'm submitting this as a non-tax resident. That created a massive false sense of security and comfort. And SARS then eventually decided, well, let's remove that box. There is no other way to do it but through a formal application process. It can only be done retrospectively, and it has to be a formal application process. Not enough time to go into the steps now. We're running out of a bit of time, but it's a formal application, and it does coincide with, and this ties on to, is there an exit tax that I must pay to SARS when I cease my tax residency? So I'll cover that quickly as well. So you do it retrospectively. It's backdated to the date of departure. Then exit tax, possible, not possible, really depends on what type of assets you had on the day before you got on the plane. So the date of cessation, the day you fly out, the exit tax component and potential thereof is actually the day before then. Okay, a list of 5 assets: cryptos, Kruger coins, foreign property, timeshare, unit trust, local and offshore, shareholding, private or public, local and offshore. Those assets, if any of those were relevant on the day before you flew out, absolutely, exit tax will be calculated, not always payable. You get the exemptions, etc. Part of our value proposition is to prepare you for that submission so that you know what to expect when the exit tax calculation is then actually concluded. Now, what if I just leave? Tell SARS nothing, but return after 10 years. We know South Africans got their head in the sand. They're saying, well, I'll cross the bridge when I get there, etc. They don't cease residency. They remain, because there's no formal application, no resident confirmation letter issued by SARS. Bottom line is, still tax resident. You actually have an obligation. So if you come back to South Africa 10 years down the road, you've not ceased your residency, and you now want to become economically active in South Africa again, non-compliant, admin penalties, but basically you're in breach of SA, of SARS regulations. And we obviously know that they're not messing around at the moment in terms of issuing fines and non-compliance letters. And that could then be worldwide income, which should have been declared, but wasn't declared, possibly worldwide assets that were acquired. You know, you were oblivious to the impact of that, but some of these assets could have capital gains tax triggers, and you've now acquired those as a South African tax resident. So definitely have to avoid, don't have your head in the sand, get rid of SARS. What happens if I cease my tax residency with SARS, but then return after 10 years? That's the way to go. You don't draw the line in the sand just because you tax immigrate, okay, or cease your tax residency. You can come back. You don't lose citizenship, IDs, passports, how you travel, etc. What you do is you ring fence your foreign assets, your foreign income out of a SARS net, which is ideal. Your ability to return to South Africa doesn't get influenced. Your tax number, if it hasn't been deregistered, you literally just update your personal details with SARS, normal income, taxable again, etc. So it's basically in that scenario where you've ceased residency, you've done the right thing, ring-fenced your foreign jurisdiction, life and income, come back to SA, and it will pretty much be status quo as it was before you left the country initially. I've rattled through those. Sure.
Well, thanks, Peter. I think what we've also seen is there's a trend of a lot of South Africans coming back. So I think the theme of this webinar isn't just about how to get money out, invest offshore, look at alternative jurisdiction. It just also speaks to the need for planning throughout the whole lifeline of this topic. So a lot of our clients are also returning. They do have funds and wealth that they've accumulated abroad. They'd like to place it in a structure or a vehicle and plan accordingly before they become tax resident again in South Africa, before they return. So again, this is not something that just happens, it's something that you have to review quite often. And we implore clients to engage with the necessary professionals accordingly. I see we do have some questions. We're just going to address about 6 different common misconceptions in the market that we frequently pick up on in the South African office. Peter's table sees a lot of this as well, and we're just going to cover that. Peter, over to you.
Yeah, just quickly run through those. So biggest misconception that I find every single day is living abroad, want to cease my residency, can't cease it because I've got assets, I've got business interests, bank accounts, retirement funds in South Africa. You can draw the line in the sand, etc., and retain the South African assets. There's obviously the deemed disposal of the capital gains tax I mentioned earlier. That's the biggest misconception. Then ceasing my South African tax residency will not impact my ability to transfer funds in and out. As I mentioned, before you tax immigrate, use your allowance, 1 million, 10 million, etc., normal application. After you've ceased residency, don't lose the ability to move your funds. But now it's looked at not monetary value, it's looked at is this income or is this capital. Formal processes in place, done every day, no issues. Then lastly, from our side, if I obtain second residency and leave South Africa, I automatically no longer have an SA tax obligation. Again, not the case. Ordinary resident-based tax system, if you don't cease your residency formally with SARS and get the non-resident status, you have an obligation from a worldwide income and a worldwide acquisition of assets perspective, etc. Any SA-sourced income, except then in Bongi's example, if she's become a non-resident and it's interest income, section 10(1)(h, will always be taxable at source by SARS. Okay.
Absolutely. And I think just to touch on the point, the exit tax that maybe and will be calculated when you do cease tax residency doesn't have to appear as scary as it sounds. So I think there's a lot of planning that can be done, especially where we look at business interest. So there's a lot of preservation that can take place if you deal with the right firms, tax advisors, of course, very important to get the right tax advisors. Say, these are the assets that I have. This is the jurisdiction that I am going to. What structure makes sense to preserve the transition of those assets and, of course, the tax residency change? So sometimes we want to just close our eyes and move forward, but it's good to unpack everything. And within the plan, you can establish whether it is going to be as severe as you've been told, maybe around a braai, that it might be. So I'll move on to some misconceptions. So again, I've spoken to this earlier. Just because I've obtained an alternative residency or citizenship doesn't mean that I'm automatically a tax resident of that country. So this is I think it's one of the biggest misconceptions maybe that Peter and I see in South Africa. Just because I have an alternative residency doesn't mean that my tax obligation ends. We've specifically touched on that quite a lot. And then of course most of these residency rules within countries, each government sets them and they all are different and they change, like the the UK. A big bomb was dropped recently with regards to the UK's tax position. So again, you need to understand that the rules are set by each country. They can change, and how does it apply to you if you do leave the country, if you don't? And of course, it's usually based on domicile, or it's based on presence, physical presence, and Kerry alluded to that earlier as well. If I obtain an alternative residency, or I seize my South African residency is jeopardized. Not at all. So again, let's speak to a popular jurisdiction, Mauritius. Just because I've retained or obtained a residency permit in Mauritius and I like to travel there frequently, doesn't mean that you don't want to still call South Africa home and return. So it doesn't jeopardize at all. It is just important to understand what are the rules with regards to citizenship rights and obligations. I'm a South African citizen. I have a passport in South Africa. I'd like to purchase or make a donation and go the Caribbean route and obtain the passport through that route. What does that mean for me? A lot of clients who have gone to New Zealand, who have gone to Australia, Canada, we see often the United Kingdom. I have this dual citizenship. What should I do? Or I want to approach for that and make an application with that government to apply for that passport. So really important to understand that. And of course, it can change, as most legislation dealing in the space that we do changes quite frequently. So really important to just discuss that with someone before you do pull the trigger. I see we've hit 11 on my side in SA. So we have come to the end of our presentation. There are some questions which I feel could be more for Peter than anything else.
I'm just
I'm going to share
quickly.
I'm going to share our contact details with you. Those of you who are still hanging in there, please feel free to jot down our contact details, our email addresses. We are very friendly. We'd be happy to field some questions and explore some scenarios with you. Peter, do you want to address those? I think you have addressed one specifically, but
I have. So what are the requirements taken into consideration? Grey listing of SA. For the moment, SDA allowances 1 million really hasn't had any change. Okay, so it's business as usual. It's becoming more difficult to open bank accounts in other jurisdictions while you're still in South Africa. Most jurisdictions have done away with that, but actually getting the funds out of the country using the allowance, that hasn't changed at all. The grey listing hasn't impacted our side of the equation, possibly the other side where the funds need to arrive. Then the question, what are the implications of someone who's gone through formal process of ceasing tax residency? Could they pay tax? Not at all. 100% not at all. If it's done retrospectively, which is the only way to do it, backdated to whatever, 2017, and now eventually you come back to South Africa, whatever happened from 2017, from an income generation, asset acquisition perspective, will be outside of a SARS net 100%. So that's why it's important to not do nothing. and then so I've sold everything and left 2 years ago. Can I now go to SARS and tell them that I want my cessation date to have been 2 years ago? I can't see you ask that question. Unknown user. My short, very quick answer to that is no. But if you could send me, you've got my email address, so if you could send me your details, we can take that question, just discuss that further. There's possibly a few variables hidden in that one liner there that I might not be aware of, and that's dangerous to comment on. That's all. Need to drop off. Okay, cool.
All right. Well, I think I see there is everyone just saying thank you, those who are heading out. It's been a pleasure to host this webinar with colleagues Peter and Kerry. Thank you very much for joining us today. Again, you are welcome to contact us. We're all on LinkedIn if that is easier for you as well. And please feel free to reach out anytime. Thank you so much. Thank you, Kerry. Thank you, Peter.
Thank you all.
Thanks, Kerry. Bye.
Thank you. Bye-bye.
Cheers. Bye.
Ciao.